is pleased to welcome you to today's webinar, the Q3 U.S. Economic and Credit Trends Outlook. My name is Teresa Fries, Senior Director of Portfolio Marketing at Equifax, and your host for today's webinar. On behalf of the entire team at Equifax, I want to thank you for attending today's webinar. Our goal today is to deliver timely insights on the economy and key trends in consumer credit that can help drive strategic growth at your organization. Whether you're looking to benchmark your company against the national market, better forecast your book of business, or even monitor shifts in the economy and industry in general, we are sure you'll find value in the insights delivered today. Please note that today's call is being recorded and all participant lines will be muted during the broadcast. This presentation is scheduled to last 1 hour, and we encourage you to submit questions at any time by typing them into the chat box in the lower left corner of your screen and clicking the send button. If we don't get to your question during the Q&A section at the end of today's presentation, we will send a follow-up email with responses to all of the questions in an FAQ format in about 2 weeks. The webinar will be available for replay and the presentation available for download. You will receive a follow-up email with a link to the recording and presentation within about 24 hours. Over the next hour, this webinar will include an overview of the U.S. economy, where we will provide an update on consensus forecasts and take a look at interest rates, a brief labor market update, and macro trends impacting the U.S. economy. We'll then touch on the U.S. consumer credit trends, overall trends on consumer credit, as well as a brief deep dive into mortgage, auto, and credit cards, and our special report section, a view of developments in online lending and unsecured personal loans. How does reality compare with industry myths? If you're joining us for the first time today, we present on a different topic in our special report section each quarter. Past quarters have focused on the recession outlook, subprime auto trends, credit tightening, and even private label credit cards. At the end of today's webinar, you'll have an opportunity to suggest a topic for upcoming webinars, and we encourage you to take a moment to share your recommendations. Now, before I introduce today's speaker, we would like to introduce one polling question today. We'll have a couple throughout the webinar, so we do ask that you stay tuned and respond to those questions as they come up. We do want to get a sense of who is on today's call. So our first of 3 polling questions is, how would you best categorize your company? Would you say that you're a traditional bank, a credit union, a finance company, online lender, card network or issuer, a mortgage or auto lender, telecom or utilities provider, or other? So please select the response that you feel most closely describes your organization. Now, we'll give folks just a moment to respond, and there's no hard and fast rule for your response today. We're just looking for directional information. So again, how would you best categorize your company? Now, as folks are responding, I'll take just a minute to expand a little more on our special report topic for today. As mentioned, we are going to take a deeper dive into trends in online lending and unsecured personal loans. We'll take a look at a variety of things, including total originations by lender type, loan balances, and score ranges, comparing online lenders to the more traditional banks, credit unions, and other lenders. So let's take a look at the results, and we have a good majority, over a third of you are with traditional banks, or approximately 1/3. We have about 1 in 5 from credit unions. We have a good number of finance companies and a whole bunch of other. So thank you guys for taking a moment to respond to that polling question today. So at this time, it is my pleasure to introduce today's speaker. Gunnar Blix is Deputy Chief Economist here at Equifax. Gunnar analyzes consumer credit trends and the U.S. consumer economy, focused on the auto, banking, and mortgage industries. Before assuming his current role, Gunnar led customer analytics for our mortgage vertical and provided analytics support for capital markets. He has more than 15 years of industry experience, focused primarily on property analytics, mortgage prepayment, and default risk for housing. But he has also ventured into customer relationship and risk models for the auto, banking, insurance, telecom, and travel industries. Gunnar has served on a number of industry conference panels and his insights have been frequently featured in media outlets such as American Banker, Bloomberg, Wall Street Journal, and more. And with that, I will turn the presentation over to Gunnar.
Thank you, Teresa, for that introduction, and thank you all for being with us today. I really appreciate the opportunity to talk about our view of the economy in general and about credit in particular. I know you have busy schedules, so I appreciate you taking time out for this. And as Teresa mentioned, we will start looking a little bit on the macroeconomic trends at first. So coming out of Q2, all of our key indicators really were solid. We saw GDP growth top 4.1%. We saw personal consumption growth really bounce in the second quarter. We saw the unemployment rate hitting new lows. We saw the industrial production index, which really captures what the industry as a whole is doing, coming up. So all in all, great numbers. There was some chatter about this being the first time since 2 administrations ago that we had that good numbers. You can see from the GDP growth chart that that's not entirely true. We've seen GDP numbers like that for individual quarters through the previous administration. That doesn't mean, even though it's an annualized and seasonally adjusted rate, it doesn't mean that that is what we are going to see for the entire year. And as we'll see, there's quite some discrepancy in terms of what people believe is going to happen. The one thing that's really weighing on the economy right now is trade. And trade, what really matters in trade to the U.S. is China and Canada and Mexico, which is NAFTA. Those are our 3 biggest trading partners. You can see from the 2017 chart on the left that Canada and Mexico actually, in terms of balance, are fairly balanced in trade with the U.S. China, of course, being a different story, where 80% or so of Chinese trade is one way. And that's true for recent history as well. If you go back and look 2016 to 2018, it varies from year to year, from half to half, but in general that pattern holds, and we don't see it a change right now. Of course, tariffs are not particularly helpful, and what they amount to is a tax, and that tax basically doesn't get paid by China or Canada or Mexico. It gets paid by industry and ultimately by consumers. So it's passing on a tax to consumers that then will have to pay for it, and that drives up inflation, and then that drives down consumption. So that's the worry about trade. And worrying about the trade balance with China is a little bit like going to the grocery store and wondering why you're paying the grocery store more than they're paying you. You are, after all, getting groceries, so you are getting something for that money. So the trade balance worry is a little bit misplaced. If we look at what economists think about the economy in general, this is from the Wall Street Journal forecast, and we're using a concept that Constance Hunter of KPMG introduced, where she basically looked at the responses and said, well, how about if I map that out over quartiles? So the top quartile being the optimists, the bottom quartiles being the pessimists, about the furthest point out. What you see is that economists, between 62 economists, they're pretty much all agreeing that it's going down from here. They might not be on exactly how much, and nobody seems to think that it's dismal. It's somewhere between 2% for the pessimists to close to 3.5% for the optimists in Q2 of 2019, with some dips in between. In fact, some think that we're going to hit lower numbers before that and then bounce back up as interest rate gets reset. Others think that recessions are potentially further out. The other thing that she looked at was the term premium. So the difference, we've talked a lot about the yield curve and how that doesn't necessarily signal a recession immediately, but that it is one of the recession signals that we look at. This is the term premium between the Fed funds rate and the 10-year bond rate. Those are the ones that the economists were asked to project. And what you see there is there's a big spread between those that think it will go down but come back up to about 1.2 by December 2020, and the ones that think it's really going to go down towards no spread at all. So there's big disagreement in terms of what economists are expecting going forward. We have talked about the yield curve before. It is getting flatter. As we've said in our recession white paper, that doesn't necessarily mean a recession is imminent. In fact, it takes 18 months before, an average of 18 months from when it inverts until when the recession hits, and we are not even yet at the point of inversion. As of today, we were at 23 basis points, I believe. There's a lot of money moving around in the system. One part of that is the Fed portfolio reduction, which has started but is going to take a while, probably take us into 2023. It's possible also that the Fed may slow that down when they see what the economy is doing. It's not a set schedule. In addition to that, though, there are other things that are going to weigh on the deficit going forward. A couple of them being bonds maturing, so that's money that's coming into the economy, and so it needs to be placed somewhere else. That's going to chase interest rates. There's also the Trump tax cuts and the 2018 Budget Act. That's money that we expect in 2018, 2019 needs to be turned into bonds, and so that puts pressure on rates as well. Let's switch to labor markets. This is a slightly different view of what is happening to labor force participation than what we've looked at for a while. For every single recovery and expansion, so basically starting at the point where we were coming out of it until where the expansion ended, what's typically happened is that as you come out, the unemployment rate goes down, as well as the labor force participation rate goes up. So the arrow goes down and to the right. We see that for the first three, even for the 2002 to 2007 jobless recovery, we see that the labor force participation rate was going up even though the unemployment rate was not coming down. What we've seen from 2009 to 2015 was the opposite. As the unemployment rates were coming down, the labor force participation rate was coming down as well. And only recently have we seen a reversal of that from about September 2015 until now. We see that the trend is starting to go towards a greater labor force participation, so people are coming back into the labor force again. That's going to ultimately put pressure on wages going forward. It's going to put pressure on employers to find labor. We are still far away from where we expect to be when full employment is happening. And we see this by looking at, instead of looking at the unemployment rate, looking at the employed to population ratio. So the people employed to the population that is potentially employable, meaning not just the ones that say they want a job, but also the ones that in fact are in the right age group. We've also started to see that the job openings are now below the number of people looking for jobs. This comes from the JOLTS survey, Job Opportunities and Labor Turnover Survey. Obviously, it's the labor turnover part. and that's a good sign for driving wages. It probably will mean inflation down the road as well, and so that's one of the things that the Fed Open Market Committee is worrying about at this point. One of the things that we do look at with some worry is that the population mobility has been declining for a while now. And so even though there are jobs out there in certain areas of the country, people are not as willing to move to those jobs as they were. So there are disparities on a regional basis, on a geographical basis, in terms of where the jobs are and where the unemployed are. I'm going to, excuse me. I'm going to switch gears and talk now about consumer debt and what we're seeing in that picture. This is a chart we've shown before. It's now been adjusted to update the most recent numbers. We are currently at 13.2 trillion of nominal debts for consumers. That's above our previous peak of 12.75 back in 2009. If you look, however, on an inflation-adjusted basis, we are not yet back up to that peak. In addition to that, we have not made any adjustments for population growth, so that would be another factor that would make it less worrisome. A third factor that would also make it less worrisome is that a lot of this debt is issued at interest rates that are record lows. Particularly the mortgage debt is at record low interest rates, and so it's much more affordable for the consumer than what we saw in 2007, 2008. What's interesting, though, is that it is coming from different areas than what it was back at the previous peak. So while mortgages are now back up essentially to that level, first mortgages are essentially to that level that they were before the crisis. Again, not on a real basis, not on a population basis, and not on an affordability basis. But where we are seeing additional debt is really on the auto side and on the student loan side. Credit cards have also picked up. We've seen some slowing on that lately. What has not really come back is home equity loans and home equity lines, at least not to the extent that they were before. So some of that student loan debt, for instance, could be because people are no longer using home equity lines to get their kids through college, and so that debt has shifted from home equity to student lending. What we're also seeing is that as demand for loans is weakening, banks are actually loosening their credit standards on all except for credit cards. So this is a survey that the Federal Reserve Board of Governors do regularly of loan officers, where they give their opinions as to whether they are tightening or loosening credit, what they expect to see. This is the net difference on the ones that say they're tightening versus the ones that say they're loosening the standards. And so for mortgages, we see they're loosening it, but although mortgage demand is going down as the refinancing option is coming off the table. One interesting point here is that on the consumer loan side, where we are going to talk a bit later in this presentation, that's one area where banks are loosening standards even though the demand has weakened as of late a little bit. Banks are also tightening credit standards on credit cards, opening them for consumer loans. This is more detail basically in what ways they are tightening or loosening. So we see no score approvals are down for both. So basically you still have to have a credit a credit score, an acceptable credit score to get a loan. What they are changing, though, is maturities. So loans are getting longer on the consumer loan side, whereas on the credit card side, both interest rates and credit limits are being tightened. We're going to shift again and go into specific areas of credit. I'm going to start by talking on auto, and then I'll go into mortgage and housing, and then I'll go into cards and consumer finance before we get to our special topic. So on the auto side, we're seeing solid auto sales. They're shifting actually from sedans to SUVs and trucks, and that's happening despite gas prices going up. We're also seeing a shift from new car sales to more used car sales. That's really happening based on a lot of inventory coming off of 3-year leases, typically 3-year leases in the auto market. And so that's putting some attractive deals for consumers on relatively new cars with relatively new features where they can get it for a used price instead of a new price. On the SUV and truck picture, that's a little bit murkier. It's not entirely clear why people would favor SUVs and trucks when gas prices are going up. A couple of things that are happening is that those SUVs and trucks get much better gas mileage than they did back in, say, 2014. But also, there are incentives that the dealers are pushing that are based on how their fuel economy standards are measured. So manufacturers are actually putting more trucks out there for consumers to buy at attractive prices. So, and all of this is really happening predominantly on the prime side. Some of that is because the rising tide lifts all boats. So credit scores are getting better across the board. People have to have more options for getting credit. But what we've seen over the last year, and in fact that this is a continuing trend over the last couple of years, is that all lender types have really backed off of subprime in general and deep subprime in particular. You still have the option, and it's really the last option after you've gone to the independent finance. If you don't get a loan there, it's typically the dealer finance where you will get a loan at much worse terms, but at least you have an option to get a car. So that is a lifeline for a lot of people, and it's an important lifeline, and dealers know how to handle that end of the credit spectrum. Auto originations are generally holding fairly steady. We're not seeing the increases that we've seen over the last few years, but it's flat. It's not going down much. On the lease side, there has been a bit of a little blip. That looks like it is coming back now, and it looks like it was predominantly because manufacturers were adjusting their incentives to try to push more longer-term loans to avoid the issues that they've had with residuals on the used car market. Auto loan performance and auto lease performance are both following recent trends fairly well. They're up a little bit. The delinquencies are up a little bit on auto loans, but not enough to really worry about it. We are kind of back to a level that we saw back in 2006, 2007, so we're keeping an eye on it. On the leases, those numbers are still much, much lower than for loans, so 0.4% delinquency rate is not something that we are really concerned about at this point. The blip from last year was actually caused by a certain auto manufacturer that had some problems with their diesel cars, and that did not make their customers too happy. On the housing side, We're seeing refinance tapering off now as the rates are increasing, but so far purchase mortgages have held up fairly well. In a housing market, we are still stuck with low inventories, and that's slowing down the purchase demand. In fact, the housing starts in the most recent housing starts were also disappointing. Although there's a lot of permits out there, the housing starts have been postponed. There's some speculation about why that is happening. First of all, the biggest impact is in the West, and there are a lot of fires going on there, which is not a great environment for building houses. That's one factor. Another factor is really materials, building materials being more expensive off of tariffs on things like steel, which affects steel beams and nails, Canadian lumber, which of course affects much of the industry as well. So those being factors. A labor shortage on the construction side may be another factor. That is one industry that is heavily invested in foreign labor and immigrant labor, and so that is one of the concerns for that industry as well. One thing that we have seen over a while, and there was a journalist that wanted us to look at this, is that there is a shift in the mortgage market as to which lenders are really the most active there. We've seen a big shift towards direct mortgage lenders. They are, and non-banks in general, so non-depository institutions in general. Between the direct mortgage lenders and the other non-banks, they are currently covering more than half of the mortgage originations. Banks, traditional banks, are the ones that have really pulled back the most, mainly the national banks who have found different places to deploy their money. Super regional or regional banks and other banks, smaller banks, are still doing a fair amount of business there. Credit unions have actually also picked up a little bit of the slack in that market. They were also concerned about whether that is because non-banks are going after risky business, and we don't believe they are. If you look at the average Vantage score at origination for the various lender types, the non-banks come in slightly below credit unions, slightly below banks, but not anywhere near what we saw back in 2006, 2007. So in fact, non-banks right now are being more conservative than credit unions were before the crisis. In addition to that, breaking up non-banks, the direct mortgage lenders tend to have a higher Vantage score at origination than other lenders in that non-bank category, and that includes some servicers and sub-servicers that intentionally go after damaged loans, and so that may explain why this is holding up fairly well as well. In terms of performance, that is as good as we have seen in years. In fact, well before the crisis, first mortgages down to 1% delinquency rates, HELOCs even better than that, home equity loans similar to first mortgages, maybe slightly higher rates on the delinquencies. This is early delinquencies, 30 days, versus serious delinquencies, which for mortgage we measure at 90 plus. Shifting to credit cards and consumer finance, bank card originations are really coasting still. Not much of an improvement, but not much of a decline either. On the private label, we do see a decline. On both, we've seen the subprime share stabilize and maybe decline just a little bit. So there is some pullback going on in that area as well. If we look at the performance, bank cards are really performing fairly well. some increase in serious delinquency, but not something that we would be particularly worried about. Private label cards, on the other hand, we do see quite a bit of an increase on that. We covered that in our last webinar. So we've seen some of the reasons why that may be the case. Consumer finance, interestingly, the serious delinquencies and the early delinquencies there are both coming down and are now below the private label card levels. And so we think some of the business that is coming from the credit card side, some of the business that may be coming from the private label side, as well as other consolidation loans are really shifting into consumer finance. So there's a question about what companies make up direct mortgage lending. I'm not going to go into specific companies, but it's basically there's a host of them, and it's a fairly manual process to go through and select them out. That brings us to our special report. I think, Teresa, you wanted to talk a little bit about some of that up front?
Thanks, Gunnar. Now, before we move into our special report section today focused on online lenders, I wanted to help set the stage for our discussion. Now, in Q4 2014, unsecured personal loan originations barely broke the $10 billion mark, and less than 1 in 6 loans were originated by an online lender. 1 year later, total volume of loans nearly doubled, passing the $19 billion mark, and online lenders were responsible for about 1 in 3 originations. Now, while the sector cooled in 2017 following a shakeup in the online industry, volumes are back and online lenders are once again dominating. So Gunnar will now dig into some of the more details around this information and provide a few points of comparison between online lenders and your more traditional depository banks and credit unions. Gunnar, back to you.
Thank you, Teresa. So this is really pulled from a different report than credit trends from where we normally pull it. This particular piece is pulled from an Equifax Ignite app that looks specifically on unsecured personal loans. So in relation to sort of the consumer finance, these are not both, we're only looking at loans, so installment loans. We're only looking at the ones that we find that are unsecured. And these, and in terms of identifying online lenders, that's also a manual process, and it's a little bit different than what we look at for the direct mortgage lending. This kind of gives an overview of the things that we're going to look at, originations, and then looking at the originations by score range, loan amount, and term. Just to compare that for the various types of lenders, we're going to be walking through banks versus credit unions versus online lenders, and then the rest of the finance sectors, or the rest of the non-bank sector. Starting off, basically online lenders draw only 10 to 15% of the loans that are the unsecured personal loans that are out there, but they make up 25 to 35% of the balances. So they're definitely geared towards the larger loans. They're definitely very aggressive in that market. That activity that online lenders have done increased coming up to about 2016. As Teresa was saying, back in 2014, we really didn't see much online lending at all. It exploded till about 2016 when the industry pulled back after a couple of events that said, wait a minute, what are we doing here? What are the rules behind this category? It's come back up again. In fact, in 2017 quarter 3, we were up to $7.1 billion in loans for the online lenders, just under $21 billion for lenders in general in the unsecured personal loan space. The share of origination balances has shifted over the last few years. This shows 2016 to 2018. It was actually late in 2016 that we saw that pullback on the previous slide. And by 2018 Q1, they've actually gone quite a bit forward and then reduced a little bit again, but still definitely a big volume. The online lender is taking up more than a third at this point of the unsecured personal lending space. So if we look at it by term, you might think that these are short-term loans, and that's actually really not where the online lenders are playing. 96% of their loans in 2018 Q1 were in the 25-month plus range. In fact, some as long as 61 plus months. So these are a lot of these are longer-term loans, and not where your typical finance company plays, which is more in that short-term, less than 1 year or less than 2 year loan range. We see that credit unions and banks are fairly evenly spread over this range, with a sweet spot probably in the 37 to 60 range, but that's really where the online lenders take off.
Perfect. So thank you, Gunnar. It's time for our second polling question. So what is the average loan amount you believe online lenders extend? Now, we gave a hint earlier on in this section, so hopefully that might help you. But what do you think is the average loan amount that online lenders extend? Is it the 0 to 1,000 range, 1,000 to 2,500, 2,500 to 5,000, 5 to 10, 10 to 20, or 20 plus? Or you don't know. That's okay too. So we'll give our listeners just a moment to log their response, and this will give us a chance to see what the general consensus is before unveiling the actual information. And again, do online lenders focus on small dollar loans, or don't they? So what do you think that average loan amount is? Now we'll give you a few more seconds. Just a quick reminder, we have a lot of people still asking about a replay and access to the presentation. You will receive those in an email within the next business day, so do keep an eye out for that. All right, so we're going to go ahead and close out the polling question, and let's see what folks think. So most people think between the 5, and I think some people were listening earlier. Most folks think between the $10,000 to $20,000 or the $5,000 to $10,000 range. And we've got a good spread on the other marks. So, Gunnar, what did the stats show us?
So the average loan amount for the in 2018 Q1 for online lenders was actually $14,600 and change. So definitely they are playing in a fairly high range of loans. And in fact, loan accounts over $5,000 dominate the originations, and they've been going up as of late. You can see the sweet spot is in that $10,000 to $20,000 range, with 32% back in Q1 of 2016, now 29%. And that's really because they've shifted up to doing more of the 20+ K dollar loans.
Thank you, Gunnar. And I know it's rapid succession here, but our third and final polling question today: in what credit score range do online lenders focus their lending? Is it the Subprime, the 720 to 850, the Prime, 660 to 719, Near Prime, 620 to 659, or Subprime, 300 to 619, or again, you just don't know, which again, that is okay. So, we'll give folks a couple more seconds to respond. Again, what credit score range do you think online lenders focus? We'll give guys just a moment longer. All right. So let's see. We're going to do this one a quick result. We got most responses in, so let's see. So most folks think that online lenders focus on the prime range, 660 to 719, and then followed shortly by the near prime range. So Gunnar, again, what do the stats show us?
Yeah, so I think we lost our subprime range in that polling question. So if there's somebody who's out there who thought that we were doing subprime, they didn't have a chance to tell us that. But it turns out that a bit more than a quarter fall into the near prime range. We have it here as 600 to 659 in this app. We typically use the 620 to 659 range, so that's why the question was geared there. But 2/3 really split evenly between the prime and the super prime range. So that's what most of these lenders are going after. Not all of them, but certainly they're going after the better credit, and we've seen a shift in terms of it going up over the last few quarters, where most of it now is in the 660 to 719 range. Similarly, we talked about total loan amount range. That's also been shifting upwards. That spot is in the 10 to 20K range, but with more shifting up into the 20 plus K. So one interesting stat here is that online lenders really do less subprime unsecured personal lending than even credit unions do. So they do some more in that near prime range of 620 to 659, 600 to 659. But really in terms of the strong, the total subprime below 600, credit unions do more of that than online lenders do. Finance companies, of course, are the ones who take the brunt of that market with their shorter duration, more risky loans. So there's a question if I'm making a distinction between consumer finance installment loans and unsecured installment loans. So yes, I am making a bit of a distinction on that. Our consumer finance category includes both revolving and installment. The consumer finance installment include both secured and some unsecured loans. And some of the ones that are secured would be secured not by autos and not by student lending, but by things like boats or RVs or even some farm equipment. Certain types of sports store will fall into that consumer finance category. On the flip side of this, in fact, the unsecured personal loan category includes some lenders that started doing other things originally, and so they were never put into that consumer finance category. So there's actually, the online lenders here include some that are classified as other rather than consumer finance. That's something that we are looking to address in our next upcoming release of credit trends, which is coming out or scheduled to come out in the fall of this year. To finish it off, really on the performance side, what we're seeing is that online lenders actually perform comparable to banks and credit unions when you drill down on other characteristics. So if we look at it by quarterly vintage, it does vary somewhat. This is measured 12 months after the vintage began. So basically, the 2016 Q4 is the last vintage for which we have complete data. And you see there that they are, in fact, doing comparable to credit unions somewhere around 2%. I apologize, there's a lot of charts on this one page, and they may be, the exact percentages may be hard to read, but the point here really being that they are not the more risky in this space. If you look at it by VantageScore credit score, you also see that, as you would expect, is the lower end of the range that has the highest delinquencies. That is also the range we've just discussed where online lenders don't really do a lot of business. So they're really going after the higher 600 plus range, and the performance there is holding up fairly well. A little bit more risky perhaps in the 600 to 659 bucket than banks and credit unions, but less risky than finance companies. And finally, by term, again, the online lenders tend to focus on the longer term loans. So though we do see some performance issues in the 0 to 12 bucket, the less than 1 month loan is really not where they focus, and so we're not particularly concerned about that either. That's really all that I have for you today. So I hope that was helpful, and we can take some questions from the crowd. Yes, Teresa.
Perfect. And as a reminder, if you guys have a question, please enter it into your chat panel at the lower left side of your screen. We do have a couple of questions queued up. Someone was asking, Gunnar, what was that average loan amount again that online lenders extend? You mentioned a specific number earlier on.
Yes, so the average loan amount in Q1 of 2018 for online lenders for unsecured personal loans was $14,600 and change. So quite a bit of money actually there in terms of the loan size.
Thank you. And then
I see there's a question about the colors on 44, which is a couple of slides, I think. This one. So the colors here really just represented the score range. So the Vantage Score credit range, so 300 to 599 being the dark red, 600 to 659 being the orange, and then the prime range being the two green colors.
Okay, and then if you will let's look at slide 45. We also had a question as to the colors on slide 45. I apologize, guys. We'll make sure that we get the colors, the code on here when we send it out.
The legend there seems to have fallen off, but yes, the blue bars are banks, the green is credit unions, the red is finance companies, and the yellow are the online lenders.
Excellent, thank you. All right, we've got some more questions coming through. So what is the average term for online lenders and for credit unions? So I think we're going back a few slides. What was the average loan term for the online lenders versus credit unions?
Yep, I can maneuver us back to that, I think. Whoops, that's not, where was the term? So on the term, I haven't actually calculated the average, but I would say that for online lenders, really the bulk is in the 37 to 60 range. The average is probably right around 36 to 40 months or so. For the others, I would say it's less. The average for banks and credit unions, probably in the 25 to 36 range. The average for finance companies is clearly down in the 1 year range somewhere.
Okay, thank you. And then the next question is, what factors are contributing to the increase in unsecured personal loan lending?
So I think there are several things going on. One of the things that we do know that people are using these loans for is for consolidation. And in fact, there were a couple of studies out that said, two Fed studies that came to the opposite conclusion. One, that these loans were going after prime, like we have been indicating, and one that indicated that they were in fact going after riskier lenders, risky borrowers. And I think part of it is in the definition of the loans. They may have had different definitions of the loan. Part of it may be in that they're using it for different purposes. And so one of the things that we have seen them use it for is for consolidation loans. And one of the studies pointed out that when you do consolidation loans for a better interest rate to get money off your credit cards, what happens to a lot of borrowers is they go out and they borrow more on their credit cards. So over, say, a 2-year period, it may not improve their credit that much because they, in fact, use that as an opportunity to increase their spending on other credit, which is not the ideal way we would see that market go. But in general, we don't think that's a problem that the online lenders per se is causing. That is just it's an opportunity to get interest rates down, and people are taking advantage of it, not always in a smart way.
Thank you. And then a pretty foundational question is, what differentiates online lender from the other types? Are they backed by bigger lenders, simply doing business online, or something else? How do we classify that in our analysis?
It's a mix. So some of the lenders here are kind of the obvious lending clubs and SoFis and Prosper and Vouch and a number of others. Some of it are companies like Home Depot Loans, which actually is more of an unsecured loan, but it's for a specific purpose of upgrades. There's a mix of lenders really that go into it. It's a manual classification. Certainly somebody else might look at it differently. In general now, there used to be what we called marketplace or actually used to be peer-to-peer lending, then got retermed to marketplace lenders because as the big banks realized there was money in this, they backed their own online lenders. So there are platforms like Marcus that are really backed by bigger lenders behind the scenes. And so it's not your peer-to-peer business, it's really bigger lenders that are backing this.
Okay. We're going to shift gears just a little bit. Are you seeing HELOC applications increase or decrease year to date, Gunnar?
HELOCs are still down. We are not seeing applications really increasing on that. The credit on those are still credit on HELOCs is still very tight. It's still a very prime product, and we would expect perhaps now with the interest rates coming up that we will see more home equity lending in general. On the other hand, people are a little wary about taking on a typically adjustable rate product when interest rates are expected to go up. So we're maybe thinking more home equity loans than home equity lines, but we've seen very little evidence of it yet.
Thank you. And then let's shift to auto for a moment. When do you consider auto loan delinquencies to be worrisome?
That's a great question. I think for the particular buyer, it can obviously be worrisome to hit a delinquency. For the particular lender, it can be worrisome to see delinquencies going up. I think when we look back at the crisis, when we definitely saw delinquencies for autos come up to levels that were unhealthy, that was not what was driving the crisis. So I think we are far away from where that's really a distress point for lenders. I think as long as the economy is going well, I think it's also not much of a stressor for consumers. I think the rates are the aggregate rates are primarily going up because there had been a push into deeper subprime, and that's where some of the delinquencies were happening. I think it's still happening in the lower credit score ranges. But what's happened is that we are now so far out from the crisis that foreclosures are starting to drop off people's credit files. Delinquencies from way back are dropping off of people's credit cards. There's credit scores. Their scores are going up, and so we are seeing the stress moving up in the credit score range, and that's why we're seeing auto delinquencies raise as well. I don't think it's a fundamental problem. I think it's pockets where we are seeing poor performance.
Thank you. And so we've got time for one more question. And if you have a question still, please enter it into the chat panel. As I mentioned, we will respond to all of your questions in an FAQ format in about 2 weeks, so we'll get that response out to you soon. So Gunnar, this one touches on a response you just had a moment ago, so there was some confusion, just wanting clarity. Does the online lending include the peer-to-peer? I know you gave an example such as Lending Club, but does our online lending analysis include peer-to-peer in this case?
So it does include the ones that I mentioned. It does include a number of others. We don't have insight into all of the lenders doing unsecured personal loans because some of them simply don't report to us. So the true peer-to-peer that don't report to us would not be included. But some of the used to be peer-to-peers are now reporting to us, and most of them are actually backed by banks or larger companies.
Excellent.
We wanted to cover a few other things at the tail end. Do you want to take that, Teresa?
Yep. Thanks, Gunnar. And that actually segues right into the rest of our discussion. So as a quick reminder, Gunnar did mention the yield curve in our economic overview today. If you're interested in learning more about how the yield curves play and with the recession, engaging a recession, we do invite you to visit our website. We've got 2 resources. We have an ebook as well as a white paper that discuss recession risk and how that inverted yield curve plays. Gunnar also spoke about the employment to population ratio. We have a blog, our new and improved Equifax Business Insights blog. That's a mouthful. We do encourage you to visit our blog. It is new and improved. We have a blog there that's Are We Really at Full Employment? And that does discuss some of the differences between unemployment and employment to population ratio. So we do encourage you to visit our website. Now, really quickly, we do have the New York Fed, the Federal Reserve Bank of New York, does use a lot of our data as well to produce some analysis. So we encourage you to visit newyorkfed.org. There's some excellent analysis out there that they provide based on our data set. Now, Gunnar also mentioned some of our monthly and quarterly credit trends reports. Those are available on our website, on our investor relations website. So we encourage you to jump out there. Now, I did want to take just a second to mention we have a new solution that's specifically for the smaller banks and credit unions who may have joined us today, Credit Trends Lite. So, if that is something of interest to you or want to learn more, please reach out to your account manager. And as we're wrapping up today, we do have our 4th quarter webinar on November 15th. But what you'll see on this slide is we also have a special interim webinar on October 4th that will focus on CECL. So if you guys will take just a moment, we have 2 questions in our closing survey that do touch on CECL. So if you have a moment, please respond to those. And again, the 4th quarter webinar will be on November 15th. And so for any additional information or to learn how your company does compare to peer, please reach out to your account manager today or visit us online at equifax.com/business/credit-trends. It was our pleasure to share this information with you today, and as most of you are aware, Equifax is a global information solutions company. We use unique data assets, technology, analytics, and expertise to deliver information and create unparalleled insights through our customer-centric approach, flexible delivery methods, and scalable global platforms. On behalf of Gunnar, myself, and the entire team at Equifax, I want to thank you for your time and for joining us today. We hope you have found the information worthwhile and that it provided you with the kind of insights to help you drive strategic business at your business. We look forward to working with you in the future, and thank you again for joining us today. That does conclude the webinar. You may now disconnect.